Ethereum, the blockchain on which the bulk of NFTs reside, successfully tested a merge of its proof of work and proof of stake chains last week. Well, as investors and users look forward to the mainnet launch in the next few months, what could this mean for the blockchain's native token, ETH, and what impact could it have on crypto investing in the new economy? We have Sudhu Arumugam, co-founder of CoinFlex, a leading crypto derivatives exchange and yield platform, joining us to answer all of those questions. We have so many questions for you, Sudhu. Great to have you.
Great to be here. Thank you for having me, Angie.
Absolutely. Okay, Sudhu, for those who are unfamiliar with this merging of protocols, what does that actually mean? And how does this impact how we think about the blockchain and demand, market demand for ETH?
ETH is moving, as you say, from a proof of work to a proof of stake model under the merge towards ETH 2.0, or the beacon chain. And what this essentially means is that Ethereum goes from being technically an inflationary asset, which means that it's there's a lot more supplied every year into the market, to a deflationary asset in that what's supplied versus what is burnt means that net there's less and less ETH available in the ecosystem every year. And the mechanism for that essentially is that a good chunk of the gas fees or block rewards that go into each block is now being, instead of being given to the miners, is now being sort of burnt within the ecosystem. So it causes a scarcity, and of course that starts asking the question around, what does that mean for price?
And what does it mean for price? It's also expected to significantly impact Ether staking. How is moving to proof of stake increase yields or returns for investors? How should the market think about it?
Yeah, it's a very interesting question. I mean, right now, if you wanted to stake your ETH, typically you'll probably earn sort of like 3%, something around that. Under ETH 2.0, after the merge, we're talking about, or the market's predicting, is going to be like from 7 to 12%. And the reason for that essentially is that, unlike proof of work, which is where everyone rushes to kind of verify the next block and win the price, here there's a kind of rotational system where everyone kind of patiently waits their turn to earn the block rewards, which creates a yield. And there's lots of pros and cons with that. The pros being that there's going to be a lot less energy consumption in ETH, and the con of that is that, of course, exchanges being the kind of large custodians of ETH, all of a sudden have kind of untold powers when it comes to staking. And because we hold a lot of client deposits in ETH, and so we can stake as well on their behalf, but it means that we're now making the decisions for the collective, which becomes really the thesis of the exchanges become the kingmakers, which isn't so great either. But in terms of the price action, it's been very, very bullish. ETH is now up at $3,000 again, having tested the lows at around $2,250. And also the fact that the yields are doubling. So it is an overall bullish environment in a bearish market.
It's interesting to also understand the dynamics from an institutional point of view. As we talk about mass adoption, there's also this drive of institutionals in this space. Do you think that as ETH 2.0 comes to fruition and the move to proof of stake, do you think this is going to further institutional adoption? If so, why?
Yeah, I don't think the merge itself is a whole factor from an institutional perspective. From a retail perspective, it is, because under ETH 2.0, there's kind of lower gas fees and more certainty in fees, which is important for retail users. If you're an institutional user and ETH fees have been pretty horrendous this last 18 months, I don't think you really care about fees spiking from $30 to $200 if you're an institutional customer. I think for the institutional customers' adoption, to your question, I think really what we need more around is the UI UX of interacting with DeFi, and there's a lot of things going on in that front. We've moved along for MetaMask is obviously a great bit of tech. Now we've got sort of institutional grade MetaMask with a lot of custodians providing this within a more secure institutionalized framework, as opposed to having it on your browser, on your computer, and keeping it permanently hot, for example. I think those sort of incremental additions is going to help with institutional adoption.
And there's so many more ETH killers, if you will, and layer 2 solutions that are also driving more people into this space beyond just ETH. But it's great to see all of the innovation in this new economy. It's great to talk to you, Sudhu. Really appreciate the insights here.
Thank you for having me, Angie. Great to chat.